Okay, a very good evening, guys. Can you all let me know if you all can hear me and see a screen? Yes, can see a screen. Nice. Okay, so today is, I think we've done around 4 classes so far for unit number 4. Today is, sorry, not unit 4, unit 7. Today is our 5th session, and we're going to start a new topic called the monetary policy. So it's a little bit of a tricky area. It's something that is definitely tested in your paper. There is a lot of current context also involved regarding this, right? How the central bank controls it, what they did during COVID, how did they use this policy during the economic crisis, what are they doing right now? So there's a lot of current context also involved when it comes to this topic. So we are starting this newly. It's not connected very much to what we have done before. We have done around 4 classes. It's not connected very much. So in case, even if you all have missed those 4 classes, it should not be a big problem. You should still be able to catch and be able to get this right. Unit 4, not in unit 4, maybe in business, you would have studied a little bit about this, right? On monetary policy. So shall we start and get going? So today's class is until 10. My plan is to finish until around page number 28 in the table to finish this instrument area. I think we should be able to finish. We'll see. Anyway, I will not be rushing on this because there is no point rushing on it. Uh, we will get this. And also one more thing, most likely next week. Now in our revision class, next week we need to start unit number 6, but we don't have the printed tute yet. I didn't get it from the printers yet. Not sure when I would get it. Most likely should be able to get it within the next few days. So in case I don't get it on time, what I'm planning to do is for next week, the 2 theory classes that we have on Monday and Tuesday, sorry, the 2 revision classes that we have on Monday and Tuesday, to make that also a theory class. So that means next week, instead of having revision and theory, for 2 days we have revision, 2 days we have theory. We'll most likely have 4 theory classes, and then the week after, we'll take a break. Most likely then next week I will be able to finish off unit 7, and then the week after we can take 4 revision classes in case the tute gets delayed. Okay, that's what I'm thinking. I'll inform on the group also anyway, in case there is a change. Okay, right, we'll start. Starting from page 23 in your tute, monetary policy. What is this monetary policy? You all would have heard a little bit about this if you all have done maybe business studies as well. I think it's a little bit there, here and there in business studies. So, but here we are going to go into it much more detail than what we do in business studies. So listen very carefully. Today is a 3-hour class, our normal time, 7 to 10. If I can finish the area early, I will finish the class early. That depends on how it goes. Okay. Starting. Okay. So what is this monetary policy? How does this usually work? Yes, monetary policy is a policy that the central bank uses mainly to control the money supply and the interest rate in an economy. What is monetary policy? A policy that the central bank uses mainly to control the money supply and the interest rates. So now the question is, so why are they controlling money supply and interest rate? What is the objective? Remember, central banks or even economies, one of their main objectives is what? To have price stability, no? So you know how it works. Nice, right. Let me quickly show you how this basic story works. So central bank, to go to my note, I'll quickly show you this. Okay. So the central bank using their monetary policy. Now, under monetary policy, guys, there are so many tools. There is this standing deposit facility rate, standing lending facility rate, SRR, open market operations, all of that we will talk about, right? Don't worry. So using this monetary policy, this is what the central bank does. you have the monetary policy. Using this monetary policy, the central bank tries to control, mainly what they do is they try to control the interest rates in the economy. So when I say interest rates in economy, it's all the interest rates, deposit interest rates, savings interest rates, loan interest rates, treasury bill, treasury bond, everything. No? So using this monetary policy, what they try to do is they try to control the interest rates in economy. Mainly, they try to control interest rates in economy. By controlling these interest rates, they are mainly able to then control the money supply. They are able to control money supply in a economy. So then the question comes, why do you control money supply? What is the reason? Why can't you just let it be? By controlling money supply, guys, any guesses? What can you control? If you can control the amount of money that is there in the economy, what can you mainly control first? You can control, yes, you can control inflation, but before that, you can control something before. What can you control before that? By controlling the amount of money supply, guys, you can mainly control, you know what? You can mainly control the aggregate demand in an economy. The aggregate demand in an economy. So by controlling, remember we studied demand pull inflation. මතකද? When the central bank's money supply increases, remember the quantity theory also, MV equals PT. If the money supply increases, aggregate demand will increase, prices will go up. So by controlling this money supply, you can control the aggregate demand. Now connect this a little back to demand pull inflation, if you all remember. If the aggregate demand increases, prices start to go up. If the aggregate demand decreases, prices start to come down. So by controlling aggregate demand, what can you try to control? You can then control the price level in an economy. What is the price level? In other words, you can control inflation. So this is how mainly using this monetary policy. So what are we going to study today? We are going to talk about this. We are going to talk about this monetary policy. How using this monetary policy, how does the central bank first control the interest rates in economy? Then using these interest rates, how do they control the money supply? Then how does that go and affect the aggregate demand in economy? And then finally, how does that affect the price level? So it's a very interesting story. Again, not something that you all can memorize. You all need to logically understand, this is what is happening. If the central bank increases this, this is how it's getting controlled. This is what is happening to money supply. Then this is how it will work. So it's a very logical thing to understand. Again, if you understand it and put it into your head once, you will not forget. You need to put the logic into your head. So I will teach it to you with the logic. I will give you some real world examples also going forward. You need to remember. If you try to memorize the Tutlamai, it becomes definitely impossible. So that is basically the monetary policy and the objective of it. What do we do? What is monetary policy? The monetary policy we say is what? A policy used by the central bank to control the interest rates and the money supply in economy. Why control interest rates, money supply? Because by controlling those, you can influence the aggregate demand, and then finally, you can control the price level. That is how it works. So far, we find basic story. Yes. Okay. Now, to conduct this monetary policy, guys, the central bank has a framework. Now, what is this framework? Now, for example, just think, now you all also know what is your central bank's objective is monada to control prices, not keep prices in economy stable. So now what is your objective? Let's say your objective is to somehow get a good result for A levels. So to get this good result for A levels, you all also have like a set of things that you all follow, no? General thing is, you need to go to school first. then you need to come to class. You all need to do past papers. Like that, there is a small framework, no, like a small set of guidelines, set of, overall path to follow. Ah, just like you all have a path to follow. If you all want to get good results, there is a path that you all need to follow. So just like that, if the central bank wants to control prices, there is like a path that they have to follow as well. That's what you call a monetary policy framework, like a small, some guidelines, some path to follow. So central bank's monetary policy framework is called, you know what? Currently, it's called, okay, the flexible inflation targeting framework. Okay, this recently changed now. This is called the flexible inflation targeting framework. That is what you call central bank's monetary policy framework. So you know what does the central bank do? Now, recently changed on 2024, they made a small change. So you know what does the central bank do, guys? In this, what is this flexible inflation targeting? We're going to talk a little bit about this framework first. Okay, this is how it works. Now, under monetary policy, we're talking about what? The monetary policy framework. What is framework, Lamai? Framework is like a set of guidance, like a plan to get to your goal. You all think you need to get 3 A's. To get your 3 A's, you all have a plan. That is what you call the monetary policy framework. So this framework I told you, the current framework is called Monada. The current framework is called the flexible inflation targeting. Flexible inflation targeting framework. So what is this flexible inflation target? This is how it goes. It's very interesting. Huh? I'll show you some real world, give you some real world info also. So every quarter, now earlier it was every like a year, but now inflation is a big problem in Sri Lanka. So now you know what they do. Now every quarter, you know whom? Central bank governor and his team, they will publicly announce for this quarter. What is a quarter? 3 months, no? So every year has 4 quarters. January to March, April to June. Likewise, there are 4 quarters. So every quarter, the central bank publicly announces an inflation target. So they have a forum, they publicly announce. Does anyone know what is the current inflation target? Oh, this quarter, now 2024 we are in. How much has the central bank announced publicly? Sometimes they will change it for the next quarter. Sometimes they will reduce it. Sometimes they increase it. They have a public announcement. How much have they announced? So right now, how much do you all think? Their target is like to keep inflation at you know where? To keep inflation at a mid-single digit. Keep inflation at a mid-single digit. So what is the mid-single digit? Single digit means one number. Mid-single digit, that's a 5%. But you can't keep it exactly at 5%. No. So central bank has said for this quarter, we are going to keep inflation. Our target is to keep it between 5% with a plus or minus 2%. What is that? 5% with a plus or minus 2%. What is that? So that means inflation can be either 2% less than the 5% target, that is the 3%, or it can be, let's say, 7%. That is what they have publicly announced now. So central bank governor, under the flexible inflation targeting framework for 2024, the first quarter. Sometimes for the second quarter also target is the same. They don't have to change the target. If there is a need only, they will change the target. So right now, they have told, central bank governor has told, our target for this quarter is to keep inflation at where? At the mid-single digit mark. But we understand there can be small variations. So a plus or a minus 2% is fine. So maybe 2% less than 5%, that is 3%, 2% more than 5%, that is a 7%. So guys, if you all were there on the group, how much did I send you? What was the number? How much was the NCPI inflation for December? I sent you the screenshot on the group. How much was the number? NCPI December. NCPI December 2023. I told you the information is released on the 21st of November. What was the exact number? Go back and check in the group. Give me the exact number. 4 point how much? Was it 4.2%? No, and product stay updated on what is happening, right? Then it becomes very interesting. See, then can you tell me, so far, are we in line with this target? Is the central bank okay with this target? Yeah, no. What did we, so no, it's between 3 and 7%. Fine, no problem. And what did we predict for January? Remember inflation, how much did we predict? Colombo Consumer Price Index, we predicted around 6%. No, we don't know. On 31st of January, I'll let you all know. Okay. So we predicted around 6%, right? So 6% also still fine, no? Between the 3 to 7% range. So that is how it usually works. So now let me summarize the story. In order to conduct the monetary policy, central bank has something called the monetary policy framework. What is a framework? A framework is like a plan. Framework is like a plan. So central bank's monetary policy framework is called, the current framework is called the flexible inflation targeting framework. Called the flexible inflation targeting framework. So in this flexible inflation targeting framework, what is this flexible inflation targeting framework? So flexible inflation targeting framework is where the central bank publicly announces, they publicly announce their inflation target. They publicly announce their inflation target. Okay. Currently, they have announced it as a mid-single digit with a plus or minus 2% variation. They publicly announce this target, and what do? And would use their monetary policy tools to keep inflation at that level. So they will publicly announce, and then what do? Or there are different monetary policy tools. We will learn that. There is SRR, standing deposit facility, standing lending, so many tools we will learn. They will somehow use those tools, and they will somehow keep inflation at that level. Will they check inflation? Yes, inflation is measured every month. I'm hoping you were there. We saw monthly inflation. No, below the target is also fine. It's not an issue because this is called flexible inflation targeting. So that's why we are not saying inflation doesn't have to be exactly 5% in a way. It's flexible. 5% with a plus or minus 2% variation. So 2% less, 2% more, no problem. We are in our target. So we don't really say that it's below the target. It's not an issue. Okay. That's the basic framework. Central bank will have something called the flexible inflation targeting framework. They will announce a figure. So right now they have announced a mid-single digit. Come on, guys. Mid-single digit, get it from the term itself. Single digit means one number. Mid-single means in the middle. So what are the one numbers? 1, 2, 3, 4 until 9. 1 to 9 are called single digits. So mid-single digit means somewhere around 5%. That's what they have publicly announced. That's the basic framework. Now, Lamai, before this framework, now flexible inflation targeting came somewhere around in the, this was announced somewhere around in the 2019, Lamai. If I'm not mistaken, the year, this is where this framework was announced. Before this flexible inflation targeting framework, back in the day, in somewhere until from 1980s to around the 2010, the framework was called what? What was the framework called? It was called something called the mic. They are not going to ask you much, don't worry. Right? It was called monetary targeting. It was called monetary targeting. This is those days, monetary target. And then again in the 2010s, somewhere around in 2015, they changed this framework. Okay, they modified this a little. Somewhere around in 2015, they came up with a newer plan that is called the enhanced monetary policy framework. I'll say monetary policy MP. Yeah. This enhanced monetary policy framework was the new one in somewhere around 2015. Now I remember in 2017, the year that I did A levels, there was a question. There was a question asking to explain the current monetary policy framework. So in that 2017 paper, what did we have to write? We had to write about this enhanced monetary policy framework. So this enhanced monetary policy framework was a combination of, this thing called monetary targeting plus flexible inflation targeting. We say FIT, the current one. So then they realized two things put together is a little bit of a mess. Then from somewhere around 2019 onwards, they cut this monetary targeting off. So earlier, back in the day, there was the framework was called monetary targeting. They had like a small target. Day-to-day target is this, intermediate target is this, final target is this. They had certain targets. We don't have to learn that. I teach this for the previous batches, but for your batch, I feel it's not needed. They're not going to question because those are now very out and old. So there was something called monetary targeting. Then they changed it a little. That was called the enhanced monetary policy framework that had monetary targeting and flexible inflation targeting. Now what is there? Now they cut this monetary part away. They said not needed. And now the current monetary policy framework is only the flexible inflation targeting framework. What is this called? In short form, we call this FIT, flexible inflation targeting. So when you all maybe read certain news articles and all, you all will see the word FIT. So what is FIT? Flexible inflation targeting. So now we'll go through the note a little to see whether this is somewhere around 2019 this was introduced. Okay. So we'll go through the note a little to see what is this. Okay. Here. Monetary policy framework. Yes, I'll give you a time to take a screenshot. Okay. They say at present, the central bank conducts its monetary policy in line with a flexible inflation targeting framework that we know. Aimed at what? Aimed at stabilizing inflation at a mid-single digit. So what is their aim? To keep inflation at a mid-single digit over the medium term. What is medium term? Usually we can take a quarter line. Like 3 months is considered as a medium term. While supporting economic growth to reach its potential. Now, remember, these interest rates and all have a big impact on economic growth also. I will show you all, when we learn economic growth, we will learn in detail in unit number 11 and 12. Right? You all will understand it very, very well then. Okay. So then here, see, in terms of operational aspects of this framework, the central bank uses its monetary policy instruments to guide short-term interest rates, particularly the average weighted call money rate. Now it's like this, guys. Try to understand this problem. What is the monetary policy framework? A plan, no? Like a pathway to follow. So current monetary policy framework is called the flexible inflation targeting framework. So what has the central bank done? Under this flexible inflation targeting, they publicly announced, look here, this is my target. So right now they have announced mid-single digit with a plus or minus 2% variation. Between 3 to 5%, we will keep inflation. Now connect this with your story. Okay, what is your target? Your target is, okay, I want to get 3 A's. Some of you are not just 3 A's. I want to do even better. I want to get a island rank. You have a target. So then to achieve this target, there are things that you do day to day, no? To achieve this 3 A's or island rank, whatever target, there are things that you do daily. What do you do daily? What is your operational aspect of your part? What do you daily? What should you do daily to get to your target? Your target of getting 3 A's or an island rank. What do you need to do? In very basic context, what is your daily target? Daily, you will have to study, you know, study, do papers, do questions, come to class, right? That is your day-to-day target. So then, for the central bank for them to achieve their inflation target, what is their operational target? What is their day-to-day thing? Their day-to-day target is, Lamai, to control this thing called the average weighted call money rate. Control something called the average weighted call money rate. So this is one of the main short-term interest rates. How many of you all remember the call money market? We'll go through this in detail. You'll remember that. Call money market. Yes. Right. So basic context, we will anyway go through this in detail, right? Right now, it must not be very clear for you all. Don't worry, because we will talk about this in detail. So let me quickly summarize what I have taught so far. So far, I started with what is monetary policy. I said monetary policy is a policy or an instrument used by the central bank to control the interest rates and money supply in an economy. Interest rates are called the cost of money, right? Control interest rates and money supply. Why? Because when you can control interest rates and money supply, you can then control aggregate demand, then you can control the price level. So then in order to do this, central bank has a framework, like a path to follow. So what is our framework called? The flexible inflation targeting framework. So in this flexible inflation targeting framework, what does the central bank do? They publicly announce. They publicly come and announce and say, look here, this is my inflation target. Now they have said mid-single digit. And they will use any of their monetary policies to somehow achieve that target. Now, to achieve that target, there are things that they do day to day. On a day-to-day basis, there are things they do. So on a daily basis, what they do, they try to control something called the average weighted call money rate. Control something called the average weighted call money rate. I'll come to it in a while. Is that okay so far? Something went into your head? Yes, I'll come to it. Yes, the call thing. Yeah. Fine. Yes, make sure you all listen very carefully. Don't daydream and wait, because it's very essential. You miss it, always go back, watch the recording even 100 times, watch, no problem. Okay. Now, this part, Lama, you all can read the. This is the enhanced one. I put the note that I told you, the enhanced monetary policy framework that had what? That had these things of monetary targeting and flexible inflation targeting. It was a combination of both. Then here, during the 1980s, what did they have? They had something called monetary targeting. In the 1980s, they had something called monetary targeting. Then that had little flaws, not very clear. So then in somewhere around the 2010s, 2015s, they came up with something called the enhanced monetary policy framework. That is monetary targeting and flexible inflation. And that also kind of failed. So now you have something called flexible inflation targeting. Just have an idea. You can have a read on this. Not very important, but good to kind of have a read. You can even watch a YouTube video, no issue at all. Now, guys, before I come to this monetary policy instruments, let me teach you some very important basics. Very important basics that will help you understand so much of things. Okay. We'll go to this. I want you to listen very carefully. I will give you time to take a screenshot. I will allow you to do all of that. Okay. Listen. While listening, if you want to write down, that's okay. But listening is the priority. Don't focus on writing. You can even take a screenshot and write. I'm going to teach you three main things. One is the standing deposit facility, standing deposit facility rate. The other one is the standing lending facility rate. The other one is the average weighted call money rate. Okay. We'll start with this. The standing deposit facility rate. How many of you all know this, Lama? Have you all learned this before anywhere? Know what is the standing deposit facility rate? Heard about it? Yes. No? Yes. Nice. Some of you all have heard about it. Good. Heard in business studies. Nice. Listen very carefully on how this works. Okay. Listen very, very carefully how this works. Now, let's say at the end of the day, now there are banks. No? Think of a bank below HNB, Ceylon Bank, Commercial Bank, BOC, any bank. Okay. At the end of the day, let's say they have excess liquidity. What is excess liquidity? They have more money than what they need now. Banks know, no. With practice, they know for a day, if we have 100 million enough. So customers come and withdraw, some people deposit. So for a day, if we keep 100 million in our safe, more than enough. But let's say they have more than that. Let's say now, end of today, they have 500 million. So for tomorrow, you don't need 500 million. You just assume. So if the commercial banks, right? Commercial banks, I'll say combanks have excess liquidity. What is excess liquidity? What is liquidity? Liquidity means cash. So they have excess money with them. What will the central bank tell them to do? If they have a lot of money with them, what will the central bank ask them to do? What do you all think? Central bank will say, look here, okay, you all have a lot of money with you now. No? Okay. I have something called the standing deposit facility. I have something called the what? I have something called the standing deposit facility. What is this? Standing deposit facility. Central bank says, look here, if you have a lot of money, come and deposit it with me. I have a facility called the standing deposit facility, right? Come and deposit that money with me. Now, let's say commercial banks have 500 with them. 500 million is too much. So maybe 300 million, they will go and deposit. Now, central bank, when commercial banks come and deposit, what will central banks give them? Central banks. What will the central bank do? Will they just take the money? When commercial banks go and deposit their excess money in the central bank, in the standing deposit facility, central bank is a good fellow. What does the central bank do? Central bank is right, you come and deposit, I will give you some interest also. So when commercial banks, right, when commercial banks deposit using the standing deposit facility, the central bank, I'll say CB, pays interest. Central bank pays interest. What is that interest rate called? What's that interest rate called? When the commercial banks come and deposit their money, central bank is giving them some interest. That interest rate is called the what? That is called the standing deposit facility rate. That is called the standing deposit facility rate. Can someone tell me how much is the current standing deposit facility rate in Sri Lanka? Anyone knows? It was in the news 2 days ago also. 2 days ago, they decided to keep it the same. They didn't change it. How much is the standing deposit? It's there in your tutor also at one place. Right now, Lamai, the standing deposit facility rate is a 9%. How many percent? A 9%. So if the commercial banks, once again, we are studying the standing deposit facility. What is the standing deposit facility? If commercial banks have excess liquidity, if they have no money with them, what happens? Central bank will say, Ane, come, put your money with me. I have something called the standing deposit facility. Come and put your money with me. And central bank, very good fellow. Huh? What does he do? In return for commercial banks putting their money, central bank will pay an interest also. Nice people. What is that interest rate called? That interest rate is called Monada, the standing deposit facility rate. How is more money bad thing? Not really a bad thing, but rather than just keeping with you in the form of cash, they can use it and earn some return, right? Commercial banks, it's not a must deposit. No, not a must deposit. Central bank will encourage them, come and put if possible. Commercial banks will use now. Rather than now, if commercial banks have excess money, if they just keep it in their safe, they are not getting any return. So better than that, better than just keeping in the safe, go and put in a standing deposit. It's like a short-term thing now. You can put today, withdraw tomorrow. No problem. So you will still earn something. This yes, can withdraw whenever needed. No issue at all. So commercial bank says, okay, if you have excess money, and come and put it with us. Is that clear? Standing deposit facility. Yes, every bank will deposit, not just one bank. No, these rates change every, there are Monte Carlo review meetings, they change it when they. So I'll come to this. They are not just giving interest, they also charge on the other side. I'll come to why are they giving. Okay. So then, right. Now I want you to practically think and give me an answer. Okay. X will not connect tax for now. Do they have to keep only when central bank asks? Well, they can deposit anytime, no problem. If you have excess money, you can come and deposit. You can use a standing deposit facility. You can come and deposit. No, it's not mandatory. If you want, you can. But usually it's encouraged. Usually commercial banks will do that because no point just keeping money with them in the form of cash. If they have excess money, they will put. So tomorrow you can take it if you want. No issue. Then, so usually sometimes in return of putting this money, central bank will also give them like a treasury bill kind of a thing. Okay. Yes, SRR monetary will come there. That's a different story. Okay. Now, tell me this. Let's say the standing deposit facility rate increases. Central bank is saying, if you come and deposit money with me, I will give you 15%. Let's say they increase this standing deposit facility rate. Now tell me, do commercial banks like or not like to deposit in the central bank? For a commercial bank, will they like to do it or will they not like to do it? Now, central bank says, if you have money, come and give me, I will give you 15%. They have increased the standing deposit facility. Commercial banks are very happy, no? So what will commercial banks do then? Whatever money they get, right? Even without giving loans or whatever, what will they do? They will go and put it in the central bank. So commercial banks, if this rate increases, what happens? Commercial banks prefer to deposit with the, or we'll say prefer to deposit in the central bank. Now, nice, no, when you're getting 15%, but no, if you put the money in central bank, 15%. So then If the commercial banks are going and putting all the money in the central bank, Lamai, what about the loans that they are giving to the public, to people like you and me? Whatever money commercial bank gets as deposit, people go and put in a saving, deposit, fixed deposit, they put money. All those money they are putting in the central bank. Central bank is giving a 15%. So what is happening? Loans that they are giving to people like us then? People like me, businesses, what is happening? It's reducing, right? Because whatever money that the commercial bank is getting, they are going and putting it together in the central bank. So that means the loans given to the public, loans given to the public, loans given to the public. When I say public, my firms and households, public comes down. If the loans, if there are not much loans and all given to us, what can you tell about the money supply? What can you tell about the money supply in the economy? There's a question. Can the bank crash? Can crash, but they won't. But what do you think? Now, all the money that people are putting, commercial banks are giving it to central bank. They are not giving it back to the public for loans or anything. So what is happening to the money supply in the economy? Money supply in the economy. Money supply in the economy is coming down. Not much money now. Because when public is asking loans, commercial banks say, no, we don't have money. Why? They have gone and put that in the central bank. Money supply comes down. Then now connect see, monetary policy, standing deposit facility rate. It will control interest rates, money supply and all early and come. So when money supply goes down, what can you tell? What happens to aggregate demand? Aggregate demand is the demand in the economy. So if there is not much money in the economy, people don't have money, firms don't have money, what will happen to consumption? What will happen to investment? So those are components of aggregate demand, no? Aggregate demand is C plus I plus G plus NX. So if there is no money in the economy, what happens to aggregate demand? Aggregate demand will start to come down. No money, no money. So how to spend? So no aggregate demand now. Aggregate demand comes down. So then tell me, Lamai, connect this with inflation. When aggregate demand comes down, what happens to the price level? Price level, or in other words, we call this the inflation. What happens? Starts to come down or go up. Connect with demand pull inflation. If the aggregate demand curve shifts to the left, decreases, what will happen? Aggregate demand shifts to the left. Inflation will come down, my prices will come down. Okay? Prices will start to come down. Remember, demand pull inflation. If the aggregate demand increases, under demand pull inflation goes up. Aggregate demand decreases, prices start to come down. So now, this is what the central bank did during the economic crisis. During the economic crisis, prices were high. No, prices were very high. We'll come to our real world, we'll come to it. During the economic crisis, remember 2022, Aragalia time, prices were very high. So what did the central bank do? They increased standing deposit facility rate. It's more complex than this. I will come to it once I teach others. So then what will happen? Commercial banks put all their money in the central bank. Loans come down, money supply comes down, little by little, prices start to come down. They did that. Then same thing, Lama, shall we go the opposite way? Now, opposite way, if you didn't understand, listen to this. Listen to the opposite way. Tell me what happens now. If the standing deposit facility rate decreases, central bank says you come and put money, I will only give you 5%. Will commercial banks like to put their money? Central bank has reduced the standing deposit facility. They are saying you come and put, I will only give 5%. Central bank, the commercial banks don't. No. So then, if this goes down, commercial banks do not prefer to deposit, do not prefer to deposit with the central bank. So they are not depositing with the central bank means what are they doing with their money? What are they doing with the money that they are getting as deposits? If they are not putting in the central bank, then where are they putting it? That means, Lamai, they are giving those as loans, no? They are giving it to the public. They are giving it to us. So that means loans given to the public, loans given to the public, loans given to the public, that is people like you and me, increases. Now you all tell me, if the loans given to the public increases, what will happen to the money supply, amount of money in the economy now? Commercial banks are giving loans. Come, take and go. What's happening? What happens to the money in the economy now? There is a lot of money, right? Money supply increases. When there is a lot of money in the economy, now what happens? People start to spend. Consumption increases, investment increases. What happens to aggregate demand now? Aggregate demand and aggregate demand starts to rise. Nice. But then what is the problem? When aggregate demand starts to rise, who is our friend who starts to rise? Who is the other fellow? Along with aggregate demand, and inflation starts to rise. Prashna, no? Inflation starts to rise. So in other words, inflation or the price level in the economy starts to go. See, this is how it works. And then increase in long run, bank gets more and more money. Everything keeps all those profit, right? Which is the supply that bank getting on. Yes, that's what I said, right? It's if the increases, central bank, bank gets more and more money. No, if the standing debate facility rate increases, banks put their money in the central bank. Banks don't give it to commercial banks. If the standing debate facility rate increase, that's a first situation. It's favorable for them to put it in the central bank rather than giving it to us. So they put it there, money supply comes down, inflation comes down. If it decreases only, they give it to us. Yeah. Is that basic fine? Shape. That is the standing deposit facility rate. So we have standing deposit, we have the standing lending and the average weighted call money rate. No, so they will not take the money from the central bank, they'll just keep it with them. Currently, inflation has been increased. We'll come to the real one. Okay. I'll come to call money. Okay. Now. Right. So we'll put, there's a lot of things I'll put together right now. So far, what I'm doing is I'm taking this individually. And in the real world, my central bank doesn't only use standing deposit. It's a combination. They use standing deposit, standing lending, that influences average weighted call money. It's a much more complex system. I am first teaching you the initial ones one by one. Now, this is like me teaching you ABC without teaching you words. When you go to Montessori, they don't teach you words all of a sudden. First, they teach you the individual letters. And that's what I'm doing here. I'm just teaching you one by one first. Then I will put all together. That becomes the more interesting thing. So this is the standing deposit facility story. Okay. You can get a screenshot also, Lama, if needed. I'll have my camera off, so that's my face is also there. Yeah, you can first take a screenshot of this. I will send the, okay, first we'll go to up one. Can you take a screenshot up one, but can you crop it and send without the standing deposit facility? Can you all send it on the group? If needed, you can take a screenshot that standing deposit facility, if possible, crop and send. Okay. Then this is the next part. Standing deposit facility. You can take a screenshot of this. Can someone please send on the group also, so that the ones who are not there can just make a small note. Right. Now, we'll get into the other thing. Now, what is the standing deposit facility? If commercial banks have excess money, go and put, come and deposit. And what is the opposite of this line? What is the other side? If one is the standing deposit facility, what is the other one? You have the standing lending facility. And we'll come to that. That's also interesting. The standing lending facility rate. Standing lending facility rate. Enter small circle. How does this work? Okay. Right. Let's say at the end of the day, at the end of the day, commercial banks, BOC, Sampath, anyone, they realized they have a shortage of liquidity. Maybe one customer came and withdrew a lot of money and went. No, they have a shortage of liquidity. Not enough money to continue tomorrow. Usually for a day, we need 100 million. But now they only have 20 million with them. So, hetata madi. You don't have enough money in your safe to carry on for tomorrow. So, there is a what? There is a shortage of liquidity. There is a shortage of liquidity. Shortage of liquidity in commercial banks. So commercial banks have a shortage, not enough money for them to carry on for tomorrow. So then what will the central bank tell? Central bank will say, okay, right. I know you have not enough money. I have a facility called what? I have a facility called the standing lending facility. And central bank is saying, look here, I have a facility called the standing lending facility. So if you don't have enough money, I will lend money to you. I will give money to you. Don't worry. If you don't have money, you come and ask. I will give you money. So central bank has something called the standing lending facility. Now, will the central bank give the money for free, Lamai? Will they give this money? Take and go, nikang here. I will give you money. Will they give it for free? Oh, what does the central bank do? If commercial banks come and use the standing lending facility, central bank says, right, I will give you, but you have to pay me interest. So what will the central bank do? Central bank will charge interest from commercial banks. Will charge interest from commercial banks. Those commercial banks, you say, who uses commercial banks that uses this facility. They won't just give. So what is that interest rate called? What is that interest rate called? They will say, right, I will give, I will lend to you. No problem. You don't have money. No, I will lend to you. What is that interest rate called though? That is called the standing lending facility rate. And that is called the standing lending facility rate. Once again, the story. If commercial banks have a shortage of liquidity, meaning they don't have enough money for tomorrow. So they only have 20 million, tomorrow they need 100 million. So then central bank will say, right, no, don't worry. We have a facility. We have a facility called the standing lending facility. You come and borrow. I will lend to you. But will they give it for free? No, they will charge an interest. They will say, look, yeah, I will give you money, but you have to pay me this much. What is that interest rate called? The standing lending facility rate. How much is the number for this? How much is the current rate in Sri Lanka? Standing lending facility. Standing deposit was 9%. Standing lending, how much do you think? Okay, practically think, should it be more than or less than the standing deposit? Now, central bank also wants to make a profit, no, when they are not stupid fellows, no. If commercial banks deposit, they are charging 9%. Then if they give a loan, they will charge more than that, no? So, currently how much? Currently, the standing lending facility rate is a 10%. That is the current number. Nice. Some of you are living. Good. So then, see, that is their profit margin, no? 1% profit. If now during the day, some banks will deposit money in the central bank. Now, some banks have a lot of money, they will come and deposit money. For them, central bank will pay 9%. Some banks don't have money. Central bank will lend money to them. From them, central bank charges 10%. And the central bank's profit 1%. So some of you all ask me, why is the central bank just giving interest? Why are they just paying interest? They are not just paying, because from the other side, they are charging from the other banks. They are charging a 10%, giving 9%. They are still making a profit. They are not just paying interest for the fun of it. Okay. Then now we'll learn how does this increase and decrease. Let's say, listen very carefully. Yeah. Let's say the central bank comes and increases the standing lending facility rate. They say, look here, we will give you money, but we are charging 20% interest. They have increased the standing lending facility rate. Will commercial banks like to use this now? Do commercial banks like to go and borrow from the central bank? If no money, will they borrow? Central bank is saying, right, I will give standing lending facilities there, but 20%. Will commercial banks like to borrow? No. So if they increase the standing lending facility, commercial banks do not prefer. They do not prefer to borrow from the central bank. They don't prefer. So, Lamai, now, if you run out of money and if you go to the central bank, okay, if you run out of money and go to the central bank, now they are charging 20%. So commercial banks don't like to do that. So in order to stop running out of money, what should commercial banks do? Because they ran out of money, they have to go and use this. They have to beg near the central bank, and central bank says, Ambo, I'm charging 20%. So now commercial banks don't like to go and get chartered like that. We are not going to borrow at 20%. Bank manager is saying, I now think you are the bank manager. Bank manager is saying, why should we go and borrow at 20%? Man? We will not go near that fellow. So what should the bank do to avoid borrowing from that guy? What should they do? Because central bank is saying under 20%. So to avoid borrowing at 20%, what should you do now? You should keep more money with you, no? Because when you run out of money, when you go and ask from that fellow, be like your father, no? Sometimes when you run out of money, if you go and ask money from your father says, look here, I will give you money, but you have to do this, you have to do that. You're like, no, you just keep your money. So if the commercial banks have to avoid going there, now commercial bank's father is also the central bank. To avoid going to the central bank, what should the commercial bank do? Why are they going to the central bank? Because they don't have money. So commercial banks, right? So what should commercial banks try to do? We'll come to Coleman, that's another thing, right? So commercial banks, banks will try to maintain more money with them. So if they try to maintain more money with them, then they don't have to go and ask them, because central bank is saying 20%. So if they keep more money with them, so commercial banks are keeping more money with them means, now when customers come and deposit money, commercial bank is putting it in their safe and giving. They are not giving it out anywhere. They are putting in the safe and keeping, because if the money goes down, we have to go and ask. So to maintaining more money with them means, what can you tell about the loans that they are giving out? What can you tell about the loans that they are giving out? When customers come and deposit money, what is the central bank doing? Now, just think, okay, think practically. One customer came and deposited 100,000. If they gave that 100,000 to another customer as a loan, does commercial banks have any money? No. So what should the commercial bank do? They have to keep money with them. Then when customers are coming and giving loans, customers are coming and depositing money, what will the commercial bank do? Are they giving loans now? Fixed deposit, savings deposit, people are coming and putting. They're taking the money, but they are not giving it back as loans. So what is happening? I'll summarize it again, don't worry, right? So what is happening, right? Commercial banks, banks reduce loans. Listen once again the story if you are confused. Okay. What is the standing lending facility? That is, if commercial banks run out of money, they can use that facility. Central bank will lend money to them. Central bank will give, happily they will give. But now my scenario is, this standing lending facility rate has increased. So if commercial banks run out of money, central bank is saying, I will give, but I want 20%. So now commercial banks don't like to go and get chartered near the central bank. No, it should be go and borrow at 20% from that fellow. So commercial banks want to keep their dignity and weight now. He can't borrow at 20%, then it's a loss for us. No, he can't borrow at 20%. So to avoid borrowing, tell me Lamai again, what should the commercial banks do? They borrow 20% given away now. So to avoid borrowing, what should commercial banks do? Yeah, I'm not saying they will completely stop giving loans, they will reduce. Yeah. To avoid borrowing, what should they do? To avoid borrowing from central bank, they have to keep money with them, no? So commercial banks are keeping more money with them means, what can you say about the loans that they are giving? Are they giving a lot of loans then? No. They are reducing the loans. They are only giving loans to selected people. Yes, interest rates might increase. We'll come to interest rates later. They are giving only little loans. They are not giving much. Now, if one customer comes and deposits 100 million, maybe 50 million they give as loans. The 50 they keep with them. So they don't give much loans. The commercial banks reduce giving loans. So if commercial banks and all are not giving much loans, what can you tell about the money supply in an economy? They are not giving much loans means they are not giving, they are rejecting. No, they are bad, can't give now. We need to keep money with us. What is happening to the money supply? The money supply is coming down. When the money supply comes down, now you all know the drill. When the money supply comes down, what happens to the aggregate demand, consumption, investment? What happens? Aggregate demand, aggregate demand decreases, no, comes down. When aggregate demand decreases, what happens? What happens to inflation or price level? Inflation and price level, that also comes. Price level, or in other words, inflation starts to come. That's how they can. That is the story. We'll go through the other side for those who are a little confused. Okay. Shall we quickly go through the other side of this? So listen, if you are a little confused, forget about what we did so far, listen to the other side. It's the opposite of this. Let's say, Lamai, the central bank reduced this. Yeah, so in order to avoid going and asking from the central bank only, they are reducing loans. They are keeping money with them. Okay. Now, let's say the standing lending facility rate decreases. Right now, central bank is saying if you run out of money, come, I will give you money. I only want 5% interest. They reduce the standing lending. So now commercial banks, what can you say? Will they prefer to borrow or not prefer to borrow? Hmm? So central bank is saying, you run out of money, no problem. Come to me, I will give only at 5%. Let's say only 5%. They have reduced the standing lending. So now commercial banks prefer, no problem. So commercial banks, home banks prefer. They will prefer to use this standing lending facility and they will prefer to borrow. Prefer to borrow from the central bank. So now no problem, Lamak. If you run out of money, quickly you can go ask the central bank. Central bank will give you money at 5%. So then, should commercial banks maintain a lot of money with them? Even if you run out of money, Taggala ask the central bank, they will give 5%. No problem. Should they maintain money with them now? No, right? Now, no problem. Even if you run out of money, and the friend is there, the central bank is there, Taggala go and ask the fellow, right? So now, commercial banks, com banks, do not need to maintain much liquidity with them. Liquidity means money, yeah? They don't have to maintain much liquidity. So now, because even if they run out of money, no problem. No, mean, Taggala go and ask the central bank. They will give. So commercial banks are not keeping much liquidity with them means where is that money going? What are they doing with that money? They are not keeping much money with them. So when a customer comes and deposits, where are they putting that money? When a customer comes and deposits, they are giving it to another one. This is the annual interest rate. This 10% is annual. It's not a monthly. They change it every review, but this is the annual interest rate in the 10%. Not that if you put today and take tomorrow, you will get 10%. You will get 10 divided by 365. We give it in 1 day. Right? So what is commercial banks doing now? They are not keeping money with them means they are giving loans. Loans, no problem now, right? So now the amount of loans given is increasing. Now you all know the drill again. If the amount of loans given increases, what happens to the money supply? Commercial banks are come take loans. They are giving away loans for us. They are giving for businesses. They are giving. Now what happens to money supply? Money supply starts to rise. When money supply starts to rise, what happens to our friend aggregate demand? What happens to him? Aggregate demand also rises. And this fellow also now starts to then along with aggregate demand, who is aggregate demand's best friend? Who starts to go up? Along with aggregate demand going up, his best friend, how the inflation, price level. This fellow also will start to price level go. Inflation will start to rise. That is how the story works. So if you want to bring inflation down, what should you do? If you want to bring inflation down, if you want to bring inflation down, what should you do? The standing lending facility. What should you do? Increase it or decrease it? You have to increase the standing lending facility. If you want to bring inflation down, what should you do to the standing deposit facility? See, when does inflation come down? That also you have to increase here. When you increase the standing deposit facility, only inflation came down. So if you increase the standing deposit facility, and if you increase the standing lending, if you increase both, you can bring inflation down. I will connect this with the real world. Still, we are learning pudda, right? So I quickly go and show some real world numbers. We'll come to it in detail, right? You see some real world numbers. Go in your tune to page number 30. Here, in this one, the date, these are the actual numbers, are not made up numbers. Standing deposit facility rate and the standing lending facility rate of Sri Lanka in this. You see, Lamai, what happened during this period? Now, this and this, forget about the third column for now. Okay. 2021, 2022, this period, what was happening in the country? What was happening to inflation? Inflation was 2022. What was happening to inflation? What was happening to price level? Inflation was increasing, right? It was rising. So what did the central bank, what was their objective then? What is their objective? Is it to increase inflation even more? What is the objective then? Now, inflation is rising, prices are going up. So central bank wanted to reduce inflation. Reduce inflation doesn't really mean deflation. Now, I bring the inflation rate down. They have to control it. So to control inflation, what should they do to the standing deposit, standing lending facility rate? What should they do now? What did we just circle? They need to increase the standing deposit, standing lending. Here see how they increased, Laman. Here see in August. It's not to bring it to a discipline level, reduce inflation. Yes. Okay. Yes. From 4.5% to 5.5, 5.5 to 6. They increased it a little. Then then it went to 5.5, 6.5. Then again, now inflation, now see, they kept on, SRR will come to it. I told you, ignore that for now. You see, now they increased little by little here, 4 to 5, 5 to 6. Still inflation is not coming down. Then all of a sudden, in 2022, April, they realized we can't do this. When I increase by 1% and all, they are not even caring about. What did the central bank do? And April 2022, Aragalaya peak, prices are crazy going up. Can't do this nonsense. All of a sudden, they increase it by 7%. 6.5, 7.5. Standing deposit, standing lending went to 13.5 to 14. They thought we put the increasing, not helping. If we want to bring inflation down, we have to increase it a lot. So they increase. Then again, in August, again 1%. Again, last year in March, they increased by 1%. There are so many stories behind this, why they did and all. We'll come to that. I'm just trying to show this a little bit in real world. We will talk about this in detail. Don't worry. Why is it highlighted in red? Why is the other one green? All we'll talk about it. So that's what the central bank did, Lama. So if the central bank wants to reduce inflation, what should they do? They need to increase the standing deposit, standing lending facility. Right. So the red shaded area here is the practical real world example. So to bring inflation down, Balanna, that is what they have done. SRR, I'll come to it again. The third time I'm telling, I have not taught that yet. I'll come to it. Okay. Is that shape? Fine. Standing deposit, standing lending. What it means and how does it control other things? Okay. Now, you can take a screenshot and then we'll take a small break and come to average weighted call money rate. So I'm just teaching the ABCs. I first taught you the standing deposit facility rate. Now I taught you the standing lending facility rate. After that, we'll move to the average weighted call money rate. And then I'll put all of this together. Fine, you can take a screenshot and send it on the group. Done. Okay, so we take a small 9-minute break and then we'll come into the average weighted call money rate. Yes, we have a quiz today at the end. Okay, so we need to go through, I'll just write the topic here and keep. Our next topic is the average. We are going through small parts. We're going through. The next topic is the average weighted call money rate. Average weighted call money rate. It's also a very interesting thing. Inverse relationship with what though? Don't study it that way. Don't memorize it with saying this has inverse, this has this. This is our next topic. We'll take a break until 8:30. I'll give you another break at around 9:15. Okay. So we'll take a break till 8:30. You have 7 minutes, walk around and come. Okay, so now guys, we'll go into the third important part here. We went through the standing deposit facility rate. We went through the standing lending facility rate. Today, we will now go through the average weighted call money rate. Very important rates, Lamai, because if you understand these three, most other things become very understandable. Now, we'll come to this. Remember, Lamai, within the day, now, yes, there is the standing deposit and standing lending facility, but within the day, usually, if commercial banks run out of money, what do they first do? What did we learn? If commercial banks have any liquidity problem, what is the first thing that they do? What is the first thing? If com banks face liquidity problems, liquidity problem sense, maybe run out of money or something like that. What is the first thing that they do? First thing we learned, Lamai, is what did we learn? First thing you do is page number overall is monetary policy. We are going through one by one in detail. Oh, first thing what they do is they call another bank, right? Remember call money facility. We talked about the call money market. If you run out of money, the first thing that you do, yes, standing deposit, standing lending is there. But the first thing that you do is you use the what? You use the call money facility. What is this call money facility? Remember we talked about the call money rate. What is this call money facility? If you run out of money, quickly give a call to a neighbor bank. BOC Mount Lavinia will give a call to BOC Dehiwala. Or BOC Mount Lavinia will give a call to Commercial Bank Mount Lavinia. You quickly give a call to whom? To your neighboring bank. And you say, look here, Matsan, small problem. I am running out of money. Tagala, can you give me some money? That's the first thing that you do, no? So when you run out of money or something, you use the call money facility. Tagala, call another bank and say, Ane, can you give me some money? Now, other banks will give, good fellows though. If they have money, they will give. But will they give the money for free? Will they give the money for free? No. So banks who lend will charge an interest level. Banks who lend will charge an interest. What is that interest rate called? They will charge an interest. What is that interest rate called? That interest rate is what we call the call money rate. Called the call money rate. Now standing deposit, standing lending. There is only one rate in the economy, 9%, 10%. This call money rate now can be anything, but there is a range. We'll talk about it. So if you call BOC, BOC will say, right, Mama Saldi Dendang, I want 9.5%. Sampak Bank will say, right, I will also give, but okay, I will give at 9.2%. Commercial bank will say, okay, I will give at 9.8%. Another bank will say, okay, I'll give at 15%. So different banks will say different call money rates. So there is no rule saying every bank has to charge this much. So when you run out of money, you soon give a call to another bank, right? Yeah, you can give take a loan from anyone. It doesn't have to be your own branch. Even another bank is completely fine. Another bank, your own branch, anything is fine. You can quickly call and ask for some money. That is called the call money facility. Then the bank who is giving the money, will they just give, or they charge an interest rate? That interest rate is called the call money rate. Now, different banks are charging different rates. Sampath Bank says, okay, I will give 9.5%. Commercial bank says, okay, I will give 9.3%. So different people, they take different loans, different amounts. So if you take the average of those interest rates, the weighted average of those interest rates, that is what you called, right? That is what you called the average weighted call money rate. So going forward, we won't use the long form. We will use this. We will say AW, CM. So I will quickly summarize again. This is something that we have already spoken of. Okay. So summarizing quickly, if commercial banks run out of money, yes, standing deposit, standing lending facility is there. But before any of that, first thing, what did we learn? First thing we said, when we talked about money markets, we learned call money market. First thing you do is you call your neighboring bank and ask, no? You call this fellow and ask, I'm running out of money. Can you give me some money? So that is called the call money facility. So whoever who gives money, do they give it for free? No. Okay. They charge an interest. That interest is called the call money rate. They don't give money for free. Commercial bank will say, okay, I will give money, give me 9%. Ceylon bank will say, okay, I will give money, give me 10%. So different banks will charge different interest rates. So that average of that interest rate, different banks are charging different rates. Commercial bank 9%, Sampath Bank 9.5, different thing. You take the weighted average of it. That is what you call the average weighted call money rate. That is what you call the average weighted call money rate. Now, can you all tell me, is this a short-term or a long-term thing? This call money facility? Is it a short-term or a long-term thing? Is it like a short-term loan or a long-term loan? What did we learn? This is a very short-term, Lamai. You might take money in the morning, in the evening you will settle. Sometimes you take in the evening, next day morning you will settle. Very short-term. So this average weighted call money rate, guys, is what? Is one of the main short-term interest rates. One of the main short-term interest rates that is there. So now remember, in my monetary policy framework, standing to standing short-term. Okay. In the monetary policy framework, I told central bank will try to control their operational target. Go back to the TUT and see. In the TUT, if you come back to page number, here see, right? Under monetary policy framework, I told you, the central bank uses its policy instruments to guide short-term interest rates, particularly what interest rate? Average weighted call money rate as the operating target or operational target. On a day-to-day basis, they will try to control this. How they control this, we will now learn. Okay. So far, I taught you all separately. We learned standing deposit facility rate, standing lending facility rate, and we learned average weighted call money rate. All of it we learned separately. So now I am going to teach you using now central bank now guys, can the central bank come and intervene and directly set the average weighted call money rate? Can the central bank come and tell commercial bank, if you're giving money to Sampath Bank, charge 9%? BOC, if you're giving money to this person, charge 8%. Can the central bank, does the central bank have power to do that? No, that is the bank's decision. Central bank can't come and control the call money rate. Central bank can control standing deposit, standing lending. Their rate they can control. That is their one. No. That is they are giving money. That is their thing that they can control. Central bank can't come and directly control the call money rate. Call money rate is banks are charging between each other. Now, you're giving, this is like you're giving a loan to your friend. When you're giving a loan to your friend, your father can't come and say, no, don't give this and that. It's not his one. If you are taking a loan from your father, he can put conditions. If you are giving a loan to your friend and stuff, that your father can't come and do anything. Something like that. So standing deposit, standing lending, central bank can intervene. But it's call money rate within the banks, central bank can't come and directly intervene. But the central bank can influence this. It's a very interesting story. That's what we are going to learn now. Okay. Listen very, very carefully. It's a very interesting story. If you understand this, you understand a lot of monetary policy. Okay. Listen very, very, very carefully. Average weighted call money rate. If you want, you can get a screenshot. Let me have my camera off. Can get a screenshot if needed. Okay. Right. Now we are going to talk about how all of this connects with each other. Yes, please, if you're doing any other nonsense, please keep those aside. These 2-3 hours, put your full focus here, guys, because if you focus properly and get it into your head, you don't have to waste time studying. If nothing goes into your head only, you waste time studying. You read the note, but you understand it, then you read the note, so that's how you save time. You just do nonsense and try to read the note and by heart it, won't work. So listen very carefully how this works. We are going to talk about how all 3 of the above connect. Okay. How do these connect and how it sets the other interest rates in the market? Okay. Right. Let's say now, I'll just give some random numbers now. We'll give some random numbers. Let's say currently, I'll just give some examples of interest rates. Let's say now currently the standing deposit facility rate, currently this is 9%. Okay. That means if you have excess money, you go and put in the central bank, they will give you a 9%. Standing lending facility rate, currently it is at 10%. That means if you don't have money, if you borrow from the central bank, they are giving 10%. Then let's say the average weighted call money rate. This is one of the main short-term interest rates. This is, let's say, 9.5%. Okay. Then let's say other short-term interest rates. What are these other short-term interest rates? Bank overdraft, treasury bill rates, short-term instruments, bank overdraft, treasury bills, short-term loans, other short-term interest rates. These are hypothetical examples. Let's say it is around 11%. And then long-term interest rates. Long-term interest rates, let's say these are long-term bank loans, mortgages, right? These long-term loans, right? Under those type of ones, let's say current interest rate is 13% in the market. Okay. So standing deposit, standing lending are 9-10. Average weighted call money rate is 9.5. Short-term interest rates are 11%. Long-term interest rates are 13%. Yes. Okay. Before we get into this, can you wait now? All of this is what we call market interest rates. Huh? Short-term interest rates, long-term interest rates, everything together is called market interest rates. Tell me the basic story, guys. If market interest rates increase, will people prefer to borrow? If market interest rates increase, will people prefer to borrow? Let's say bank overdraft, short-term loan, long-term loan, now very high. Will people like to take loans? No, you go to the bank and bank manager is saying, all right, Mama, I will give you a housing loan or I will give you a leasing facility to buy a car, 25% interest. Will people like to borrow? No, right? So if market interest rates increase, what happens? What happens? Demand for loans will go down. No one wants to borrow now, right? Demand for loans will go down. So no one is taking loans. Demand for loans decrease means on the other side, not much loans are being taken. No one is taking loans now. So if no one is taking loans, what happens to the money supply? What happens to the money supply? Money supply will decrease. Tell me the story soon. Money supply decreases. Then what happens to aggregate demand? If money supply decreases, aggregate demand will decrease. If aggregate demand decreases, what happens to price level? Price level low, inflation will start to decrease. No, now there is not much demand. That's the basic story. Now, okay, this is how it is. Okay. If inflation is high, if you want to reduce the price level, basically what you should do is you have to reduce the aggregate demand. To reduce the aggregate demand, what should you do? You have to reduce the money supply. If the amount of money in the economy is less, then people don't have money to spend. So you reduce the money supply. How to reduce the money supply? You have to increase the interest rates. The interest rates increase, then money supply will come down, everything will control. Now, can the central bank directly come and control the market interest rates? Can they directly come and tell a bank, for overdraft, you charge 20% now, leasing facility charge 30%, a long-term loan, you take 35% now? Central bank can't do that, Lawai. That is not their thing. Central bank can only control. Now, this standing deposit, standing lending, Lawai, is the main monetary policy instrument. Central bank can't control any other interest rate directly. Average weighted call money rate, they can't come and tell what to charge. Short-term interest rate like overdrafts, treasury bills, they can't tell what to charge. Long-term interest rates, big long-term loans, mortgages, they can't tell what to charge. So if the central bank wants to reduce inflation, all these rates have to increase. So if the central bank can't directly control, what will they do? Listen to the story. Very interesting this is, okay? This is how it goes now. Now, central bank, they can't directly control the others that we know. Central bank can't come and tell a commercial bank, a bank overdraft charge 15%. They can't do that. That is whatever the bank wants, they will charge. Central bank can't control that. So we'll look at this story now. Okay. Central bank wants to bring inflation down. Can you all tell me, what did we learn before the break? What should they do to the standing deposit facility rate and the standing lending facility rate? Or in other words, what did they do during the crisis? The numbers that I showed you also. And usually, Ramai, this standing deposit, standing lending, they won't increase only one. Both of it goes together. You also in the table also, when they reduce this all. When they increase it, they increase this all. So what should they overall do? If they want to bring inflation and all down, so the standing deposit, standing lending, they need to increase it. No, right. Let's say, and now this is where to practically understand. Let's say, Lamai, they increase the standing deposit and standing lending facility to 15% and 16%. We'll assume below. They increased it by earlier it was 9 and 10. Now they increased it to 15 and 16. We'll assume. Now, this is where you have to logically think. If a bank runs out of money, they can use the standing deposit facility. Or they can call another bank, call money facility, and they can use that. If a bank has excess money, sorry. If a bank has excess money, they can use the standing deposit facility. Or they can, using call money facility, they can give it to another bank that is there. Okay. Yes. Yes. Now I'll write this. If a bank has excess money, tell me the two things that they can do. If a bank has excess money, what are the two things that they can do? Tell me the two things. One is they can use the standing deposit facility. Anna, go and give. They can use standing. They can use the standing deposit facility and deposit in the central bank. Deposit in central bank. If not for this, if they have excess money, what can they do? If not for this, if they have excess money, they can give it to another bank, right? No, this is like after giving loans and all. To give loans, all the people have to come and borrow. If not for that, they can give it to another bank, right? Call money facility. Okay. So they can give it to another bank. So there may be other banks that don't have money. So you can give it to another bank using the call money facility. So this is what, if one bank has monada, if one bank has excess money, if they have excess money, what can they do? They can either they can deposit in the central bank. We studied standing deposit facility. Or call money facility. You can give it to another bank. Another bank calls and says, I don't have money, or you can give it to them if you have excess money. Is that clear? Those two options are there if you don't have money. If you have more money, either you use the standing deposit or you give it to some other bank. One of the two you can give. Now, we'll go with my example and numbers. Okay, this is where it becomes interesting. According to my one, now to how much has the central bank increased the standing deposit facility? How much is the standing deposit facility? Rate currently now, they have increased it to 15%. That means it was earlier, it was 9%. Now, if you come and deposit in the central bank, if you have excess money, under you will get 15%. Okay? If you have excess money, if you go and put it in the central bank is saying standing deposit facility 15%. How much is my average weighted call money rate? Now that hasn't changed. No. How much is that? Average weighted call money rate is a 9.5%. Still, the central bank can't change that. No. Average weighted call money rate is 9.5%. Now, this is the interesting question. If you have excess money, will you put it in the central bank using the standing deposit facility and earn 15%? Or will you give it to another bank, call money facility, and earn 9.5%? You are the bank manager. What will you do? Do you put it at the central bank and earn 15? Or if you have excess money, do you give it to another bank, call money facility and earn 9.5. What is the logical thing to do? Logical thing for you to do is, number one, right? No point giving it to these fellows, no man. What should you do? You have to give it to this. You will give it to STFR is what the central bank sends. So you can put it, go and put it there. Better than giving it to another bank and earning 9.5. So now do you realize, can you tell me, now if this happens, will any bank give money to another bank? Will the call money facility function? Will anyone give money to another bank? If they have excess money, will they ever give it to another bank? No, right? Are you mad to give it at 9.5%? You will obviously go and put in the central bank. So then tell me, guys, if the call money facility is to work, okay, if the call money facility is to work, this interest rate should be what? Should it be more than that 15%? Less than or equal? It has to be more than that 15, no? Because otherwise, why will anyone give money? Logically think, Lamai. Currently, standing deposit facility is 15%. So if I have now, I means I'm a bank, huh? I'm a bank. If I have excess money, I can put it in the central bank standing deposit facility. Central bank he will give me 15%. So if I have to give my money to another bank, call money facility, unless they are giving me more than 15%, I won't give them, right? So do you understand that this call money rate has to be above the 15%? Do you realize? So if they decrease that 15%, it won't work. Now let's say call money rate is 13%. Let's say the call money rate is 13%. So who will give call money at 13%? If you have excess money, why will you give it at 13% to another bank when you can give it at 15% to the central bank? Central bank has told standing deposit facility is 15%. You come and give your money, I will give you 15%. So if you can earn 15% from the central bank, Lamai, why will you give it at a rate lesser than 15% to another bank? Got it? So the call money rate has to be more than that 15%. You all agree? The call money rate has to be more than the standing deposit facility rate. Otherwise, the call money facility won't work. No one will give money. So if the call money facility is to properly function, it has to be more than the standing deposit facility rate. No, so call money facility, standing deposit facility, both are short term. You can give your money today, you will get your money tomorrow. There is no difference. There is no difference in when you will get your money back. Yeah. Is that fine? If the banks have excess money, can you quickly let me know if you all are fine? Yes. Yes, so just to summarize, guys, if the banks have excess money, two options. One is deposit in the central bank. Option number one, standing deposit facility. Option number two, give it to another bank, call money facility. Standing deposit facility, call money facility. In my example, standing deposit facility, central bank has increased now. They have said standing deposit is 15%. Yes, both are short term. Standing deposit is 15%. So central bank has said, if you have more money, come and put the money with me, I will give you 15%. Call money facility is still 9.5%. Will the call money facility, will anyone use the call money facility? Will anyone, if another bank calls and asks me money, will I give them at 9.5? No. I can give my money to central bank at 15. No. So if the call money facility is to function, it has to be more than the standing deposit facility rate. So it has to be more than this 15%. That part is fine. We'll look at the other side. Okay. Tell me, if a bank has a liquidity shortage, now they don't have money. Tell me what they can do. Give me the two options, Naman. If a bank has a liquidity shortage, if they are running out of money, what can they do? Give me the options. What can you do? If you're running out of money, you can, first thing is, you can use the standing lending facility. No, you can borrow from the central bank. And the central bank is there. He is saying this interest are annual interest rates. Okay. So you can borrow using what? Use the standing lending facility and borrow from how the borrow from central bank. Or else, what is the other option, Laman? CMR is call money rate, guys. If not, you can use the call money facility, no? Borrow from another bank. If you don't have money, borrow from another bank. Borrow from another bank using the call money facility. I'll say CM. Either one of the two. So if you're running out of money, either standing lending or call money facility, call another bank and ask. One of the two you can do. So now in my example, okay, we'll continue the same story. We agreed that the call money rate has to be more than 15%. That is clear. If it is less than 15%, call money rate won't function because standing deposit itself is 15%. So let's say, okay, now in my example, how much is the standing lending facility? The new increased rate is? The new increased standing lending facility is? How much? The 16%. So if you borrow from the central bank, you have to pay 16%. You can tell me how much should the call money rate be? If you borrow from the central bank, 16%. Then if you want to borrow from another bank, it has to be, if the call, okay, think Lamai, if the call money rate is 17%, okay, will the call money facility work? If the call money facility is 17%, if you run out of money, now you're running out of money. Yeah? If you're running out of money, you can borrow from the central bank at 16%. You call another bank, that bank is saying, okay, I will give money 17%. So will you ever borrow from them? Will you ever borrow at 17% from another bank? You will be like, Ane, you keep your money, man, I will take from central bank. So if the call money facility is to work, the call money rate has to be where, Laman? It has to be less than this 16, right? Because otherwise no one will take a loan from that phenomenon. Call money facility has to be less than the 16%. What is the 16%? It has to be the equal also, it can be, yes, no problem, right? Equal or less. Okay. The standing lending facility rate. Because if it is more than that, these fellows won't borrow. So now, if I am to summarize the story, look at this summary. Yes, see, Okay. First thing I told you is, if a bank has excess money, listen carefully. If they have excess money, more money, two options. One is put in the central bank, standing deposit facility, or give it to another bank. In the call money market, give it to another bank. So standing deposit facility, let's say, is 15%. So central bank is giving you 15% if you give your money to them. Okay, you have excess money. If you give your money to them, 15%. So then if another bank is asking for money, if you want to give that excess money to another bank, you will say, look here, central bank is itself giving me 15%. I will give it to you, but you have to give me more than 15%. So the call money rate has to be more than 15%, has to be more than the standing deposit facility rate. Agreed? Call money rate has to be more than the standing deposit. Otherwise, they will not use it. Then the second thing I told you is, let's say another bank who doesn't have money. If one bank doesn't have money, again, two options. Either use the standing lending facility, get money from the central bank. Central bank will lend you. So current rate is 16%. Or Tagala call another bank. Option number 2, call money facility, ask money from them. So then central bank is giving you a loan at 16%. If a other bank gives you a loan at 17%, will you take the loan? No. So for the call money facility, to work, the banks have to charge well. They have to charge less than 16%. So do you agree that this call money rate is greater than the standing deposit facility? Standing deposit facility is 15%. But has to be less than the standing lending facility. Has to be less than 16%. Otherwise, the call money facility won't function. If the call money facility is, let's say, 9%, no one will give loans in the call money market. If the call money rate is, let's say, 20%, no one will take loans. So if the call money market is to function, it has to be somewhere between this. Did that part make sense? Let's say 15.5, 15.3, 15.7, somewhere between them. It's a bit of a technical area. Not that hard, but you need to logically understand that. Yes, no? Yes, standing deposit channel is short term. Yes, reading the dude will make very, very hard. Thank you. We will anyway go through this again a little bit, Lamai. But again, I want you all to, I will upload this recording right after the class, right after this class. I will stay until night until it gets this thing. I will upload it today itself. If there are parts that you missed, once I upload, I will inform in the group. If there are parts that you missed, if there were parts that you are not clear, I want you to go through it again properly, because tomorrow's class will again be connected to today. Okay, we'll upload it tonight itself, so that if any chance you missed, you watch it tomorrow at night today or early morning, you can watch. So coming back, now tell me, Navai, in my example here, he told central bank can't directly control these, no, average weighted, then short term, long term, they can't control. But they can control this standing deposit, standing lending. Now, do you agree the moment they change the standing deposit, standing lending, it will automatically change the average weighted call money rate? You all agree with me there? How much will the call money rate be now? Can the call money rate still be at 9.5? Central bank can't directly change the call money rate. They will change this. Other fellows automatically they will change then now. So how much is our call money rate now? Now call money rate will also go up. It has to be between the 15 and the 60. Otherwise it won't work. So let's say now the average weighted call money rate became 15%. Sorry, 15.5. 15.5%. Agreed. Same. Okay. Now we'll expand our story. Now what is our story? Now if you have money, you can give it to another bank. Call money facility, you will earn 15.5%. Let's say short-term interest rates are still 11%. Now let's say I am going and asking the bank. I am asking the bank, Ane Bank, I want to expand my classes. Can you give me a loan at 11%? Short-term loan, I saw 1 week ago, your short-term loans were 11%. Can you give me a loan at 11%? What will the bank manager tell you? The bank manager, think Lamai, the money that he has in the call money market, he can give it to another bank at 15.5%. Will he give me the loan at 11%? The bank manager has money now. He has excess money now. That money only he can do whatever he wants. So in the call money market, if standing deposit, he can give at 50. Call money market, he can give at 15.5. Will he give it to me at 11%? Will he? Yes or no? The call money rate itself is 15.5. That means you can give it to another bank at 15.5. So why will he give it to me at 11%? What will the bank manager tell me? Bank manager will tell me, look here, I can give it to another bank itself at 15.5. Right now, look here, call money rate is 15.1. You don't know what this call money rate is, you're listening and waiting. Right, so you're listening and waiting, you don't know equal. He's saying, look here, call money rate itself is 15.5%. I can give it to another bank itself at 15.5. So if you want the loan, I can give it to you at 17%. If you want the loan, I will give it to you at 17%. So can you see short-term interest rates also rise? Understood. The short-term interest rate can't be below the average rate. Think again, Lama. Let me quickly summarize. Your money, yes, this is average rate, it's 15.5. You can give it to another bank at 15.5. So if you give it to another bank, you will earn interest 15.5%. So why will you give it to a customer at 11%? Short-term loan. Why will you give a short-term loan or bank overdraft at 11%? So you will tell the customer, look here, I give my money to my friend. My friend is the bank. Bank manager will say, I give my money to my friend in the next branch. He will pay me 15.5. Why should I give it to you at 11%? So if you want a short-term loan or bank overdraft or whatever, you have to pay me 17. So short-term rates rise. Clear? Okay. Then let's say one of y'all are coming to take a long-term loan now. One of y'all are going to take a long-term loan, 10-year loan, 20-year loan to build a house. Okay. So you're now speaking to the bank manager. You're speaking to the bank manager and saying, I saw your long-term interest rates were 13%. I am here to take a loan now. Can you give me a long-term loan at 13%? bank manager will tell, look here, now long-term loans are more risky lamai for the bank. Long-term means more risk for the bank. Because short-term loan, within 1 year, you will get the money back. Bank, no problem. Now, if the bank gives you a 20-year loan, what can happen to you? No, if you die, what will happen to the bank's money then? So that is more risky. So bank manager will tell you, look here, I can give a short-term loan itself at 17%. Within 1 year, I will get my money back. I can earn 17%. Why should I give you a 20-year loan at 13%? 20-year loan means more risk for me in a bank. You get more risk. Because who knows what can happen? You might run away from the country, you might die, you might go bankrupt. Who knows? So more risk means bank will charge more interest. So bank will say, look here, less risk short-term loan itself, I am earning 17%. If I want to give you a high risk long-term loan, you have to pay me at least 20%. Otherwise, I won't give you the loan. So see, Lavan, is that part clear? How the long-term loans interest rates also went up. Yes. So see, can the central bank directly control this? No. Can the central bank come and tell the bank short-term interest charge this much, long-term interest charge this much, average weighted call this much? You can't, right? Central bank can't directly come and tell. But what does the central bank do? They start the fire on this side. Where do they start? Central bank changes the standing deposit standing lending. They change that. So when they increase that interest rate, 9%, 10%, when they increase that to 15 and 16, what happened? Automatically, average weighted call money rate increases. So call money is the interest rate within banks. So within banks, now you can borrow and lend at 15. So if the call money rate is 15% to a customer, right? To a customer, if you are to give a loan, you will say short-term loan, only 17% I will give you. Otherwise, I won't give because I can give it to another bank at 15.5. Why should I give it to you at 17? So why should I give it to you at 11? So if I am to give it to you, give me 17. So short-term interest rates are 17%. So now, in a bank's perspective, Lamai, short-term loans are less risk for them. You give a loan within 1 month, 1 year, you will get your money back. No problem. That is less risk. So if you can give a short-term loan at 17%, if the bank wants to give a long-term loan, let's say you are coming and asking, honey, I want to build a house. Can you give me a long-term 20-year loan? Bank will say, right, I will give you a long-term 20-year loan, but you have to give me more than 17. Because short-term itself, you can get at 17%. Why will you give a long-term loan at less than 7? So they will say, right, I will give you a long-term loan, but you have to give me 20%. So this is the public bank, everyone together, right? Is that clear? By increasing this little by little, now this doesn't happen on the same day. Central bank increases this within a couple of months, little by little, all the other interest rates start to rise. So then here, what did we study? When the market interest rates rise, what is market interest rates again? Short term, long term, all the interest rates are short term, long term. So when the market interest rates rise, now what happens, Lavan? Now, when I went and asked for the loan, they said 17%. When you went and asked for the loan, bank said long-term loan for your house, 20%. Will you borrow? Will you take a long-term loan at 20%? Will you? At a high rate? No, right? Now, when the interest rates is high, you will say, no, never mind it. I will come next year. I will start building my house next year. Now, I also went and asked for a short-term loan. I will say, all right, no, I will borrow from a friend. So what happens? When the market interest rates rise, and demand for loans come down. So the demand for loans, no loans in the economy means now what happens to money supply? Money supply comes. Aggregate demand now prices come. So that is what happened in the Sri Lankan economy. Last year, or more particularly year before, 2022, inflation was very high. No? So to control inflation, to bring inflation down, right? We'll go back to this thing. I'll come back to the tutor. This screen also will take a screenshot. Don't worry, right? So now just think, Rama, during this red color period here, during this red color period, what was the problem? During the red color period, the problem is, what is the problem? Inflation was rising. Very high levels of inflation. So what did the central bank want to do? They want to bring inflation down. So how to bring inflation down? To bring inflation down, you have to reduce the aggregate demand. If you reduce the aggregate demand, inflation will come. How to reduce the aggregate demand? To reduce the aggregate demand, you have to reduce the money supply in the economy. How can you reduce the money supply in the economy? To reduce the money supply in the economy, you have to increase interest rates. Increase all the market interest rates. Short-term loan, long-term loan, okkama increase. Then the money supply will come down. Can the central bank directly go and increase these market rates? Can they tell overdraft charge this much, long-term housing loan charge? They can't. So where does the central bank start? They start by this. They start by increasing the standing deposit facility and the standing lending facility. When they increase the standing deposit, standing lending, little by little, average weighted call money rate increases. Short-term interest rate increase. Long-term interest rate increase. What happens? Interest rates in the market rise. When interest rates in the market rise, no loans, no demand for loans. Who is taking loans at 25% interest now? So money supply starts to come down. No money in the economy means where to spend it. Aggregate demand comes. Aggregate demand comes down. You meet your target. Inflation starts to come. That's how it works. So go back to the inflation numbers and see how it really works. Here's it. Central bank started increasing interest rates where? Here's it. Yep. Look at this very carefully now. They started increasing interest rates somewhere here. No, podda they started increasing interest rates. 2021 August, 2021 September, 2022 January, little 4.5 to 5, 5 to 5.5. They started increasing. Same period, let's go back to inflation and see. Same period, we'll go back to inflation. We'll look at the actual numbers. There are the actual numbers. Okay. Now so even though now where are we talking? 2022 start and 2021 end. Now I have not given 2021 numbers. You see, even though they were podda increasing, you see inflation is still rising. Central bank is increasing the policy rates, but still inflation is rising. So now by the time it came to around March, April, now it has gone to 20% also. Central bank realized maybe we can't increase this 1%, 2%. Inflation is still rising, market doesn't care. So what did the central bank do? What did they do, guys? Here, all of a sudden, in March, they realized May can't do this. All of a sudden, not in March, sorry, in April, what did they do? They increased it by 7%. All of a sudden, 6.5, 7.5 became 13.5, 14. They increase it now in April. They increase standing deposit. Now remember guys, this doesn't happen overnight, right? Just because you increase standing deposit, standing lending today, inflation won't come down tomorrow. For this process, now see what I have written on the side, for this to happen, it takes time. So when this standing deposit, standing lending increased in April to 13.5, 14.5, inflation won't come down in May, Lamai. In May, it won't come. So first, that has to go and change the other interest rates in the market. Average weighted, short term, long term, those have to get affected, right? Then only little by little money supply will come down, everything will then only happen. See, they increased interest rates in April, and again in July also they increased a little. Standing deposit, standing lending. But then when did inflation start to come down? Go back to your inflation numbers. Inflation until around September, it kept increasing. Policy rate hike came here. Here only they increased standing deposit facility, standing lending. In April, that is where they increased. But still inflation was rising, no? So here, 29, 39, 54, 60, 64, 69, it still it was still rising. I told you it doesn't happen overnight. So then they still kept interest rates high enough. Still they didn't reduce. So then after that only, little by little here, little by little, inflation came down. See now, last year, 2023 in September, inflation was only 1.3. Why? So they kept it at a very high level, and then little by little, it started to come down. Give me a second. Okay. Does that make sense? Yes. Somewhat. Isn't there a replacement? Apart from interest control. That makes sense. Welcome. Okay. So I'll give you all a overall summary also, guys. Don't worry. You can get a screenshot of this. Where did we write? Here, no? You can take a screenshot. Give me a second. Can you take a screenshot until here first? And then the other part you can take it after that. You can cut the top part off. Okay. And then you can take a screenshot of this. Okay. Right. Yes. Now what I'll do is I'm not going to talk of anything new. It's a lot of things in your head. So I'll take around 5-10 minutes to summarize. Can you all please make sure that you all go through this and come before tomorrow's class? I will summarize now, and then I will not drag it until 10. We'll finish by around 9:40, 9:45. We can finish. Okay. Right. So I'm quickly going to summarize all what I did so far. And yes, then we'll have the quiz. Okay. I'll summarize, we'll have the quiz, and then we're done. Okay. Listen very carefully. Okay. We started with the topic of what? Monetary policy. What is monetary policy? It's an instrument used by the central bank to control interest rates and money supply in the economy. Why do you control interest rates, money supply? Because by controlling that, you can then control the aggregate demand. By controlling aggregate demand, you can control prices, price stability. Because if you have price stability, everything else in the economy becomes stable. Then we talked a little bit about the monetary policy framework. What is this monetary policy framework? This is like the path like the path that the central bank wants will take. This is like a guideline, this one. So current central bank's monetary policy framework is called what? Is called flexible inflation targeting framework. Called the flexible inflation targeting framework. We call it FIT. So in this flexible inflation targeting framework, what does the central bank do? They publicly announce. So right now, every quarter it is reviewed level. So for this quarter, right now they have said, we want to keep inflation at a mid-single digit with a +1, this plus or minus 2% variation. That means between 3 and 7%. So then they will use their monetary policy tools. Now we studied only a few. We only studied mainly standing deposit, standing lending. Using those, and there are other SRR, open market operations we will learn. Using those, they will somehow try to keep inflation at that targeted level. So then I stopped monetary policy framework there. I told you there are a few previous things as well. Then before I go into monetary policy instruments, that's what we talked about. Before we will go to the note next tomorrow. Before I get into all of this in detail, what did I do? Is I first taught you all 3 main interest rates. What are the 3 main interest rates? One is the standing deposit facility rate. What is that? That is, if commercial banks have excess liquidity, if they have more money than what they should have, what can they do? They can go and deposit it in the central bank. Standing deposit by central bank says, you have money, no? Come and deposit that money with me. Central bank, good fellows, they will pay an interest rate in return. Interest rate is called the standing deposit facility rate. Then we studied if the standing deposit facility increases, what can happen? If it decreases, what can happen? Not going to go through that in detail. So one by one, we learned. Then after that, we learned the standing lending facility rate. What is that? That is, if the commercial banks have a liquidity shortage, if they don't have enough money, central bank will say, I will lend money to you. I will give you money. Don't worry. But do they give money just? No, they charge an interest rate. That is the standing lending facility rate. So currently, standing lending facility rate is at 10%. Deposit facility rate is at a 9%. So then we learned when this increases, what will happen? When this decreases, what will happen? Then after that, the third thing I taught you before the break, just after the break, was the average weighted call money rate. What is this? Average weighted call money rate is the rate at which banks give loans and take money within each other. No? If you run out of money, you soon give a call to another bank. Anet, give me some money. Then he gives you money. That's called the call money facility. They charge an interest rate. That's called the call money rate. Different banks charge different interest rates. So average of that is called the average weighted call money rate. It's one of the main short-term interest rates in the market. All of it individually we learned. Then I told you, in reality, it doesn't work individually like that. It's all connected. So we took in our example, these policy interest rates, standing deposit, standing lending, average weighted, short-term interest rates, and long-term interest rates. So then I taught you all, if the standing deposit, standing lending, this works the other way also. If these decreases, others will also decrease, okay? If the standing deposit, standing lending facility increases, we learn what happens. So the average weighted call money rate has to be between this, because otherwise the call money facility won't function. If the standing deposit facility is 15% and average weighted money rate is only, let's say, 9%, no one will give no. So call money rate has to be more than the standing deposit. Same way, if the standing lending is 16% and the call money facility is, let's say, 17% also? No. It has to be less than that. So for the call money facility to function, it had to be between the standing deposit and standing lending. So even though central bank doesn't have perfect control over it, the moment they change the standing deposit, standing lending, automatically, it doesn't happen immediately, not within a day, within some time, let's say maybe a few weeks, maybe a month, little by little, average weighted call money rate rises. Then when the average weighted call money rate rises, within a couple of months, what happens? Short-term interest rates will rise. Short-term interest rates like what? Bank overdraft, short-term loans, short-term deposits, those will start to rise. If short-term rates rise, little by little, after another month or so, with time, long-term rates also rise. You all need to understand that this is a process. It doesn't happen in a day or two. Central bank will set fire here. Within a couple of months, 3-4 months down the line, all the other rates have increased. So when market rates are high, will anyone borrow? Who is borrowing and taking loans at 20%, 30%? No one is taking. Demand for loans come down. No one is demanding loans. No one is going to the bank to take a loan because they know bank is asking 25%, 30%. So if demand for loans come down, that means no loans are given. Money supply will come down. Prices will start to come. That is what Sri Lanka did. In 2022, prices were rising. Inflation was rising. So what did the central bank do? In 2022, when prices were going up and up and up, what did they do? First, they started to increase policy rates little by little. 4.5 to 5, 5 to 5.5. No effect. Still inflation is rising. In April, right now, April, no new central bank governor came, right? 2022, in the middle of Taragare. Who came? Anna Nandalal came. Nandalal said, look here, can't do this, right? Can't do this. He increased rates by 700%. Done. 6.5, 7.5. He increased it to 13.5, 14. Again in July also he increased 14.5 to 15.5. He increased it more. So then, now see, this doesn't happen in a day or two, right? I told you, just because you increase policy rates today, inflation won't come down tomorrow. They increased it when? They increased in April, July, that period they increased. So when you increase these policy rates, standing deposit, standing lending, little by little, market interest rates go up. What is market interest rates? The average rate of call money rates, short-term rates, long-term rates are little by little, those start to go up. Little by little, when those start to go up, what happens? Now people are not taking loans. Money supply comes down. Aggregate demand comes down. Then within, let's say, around 3-4 months now, after increasing this, and the inflation starts to come down. So connect it with the real timeline. In April, July only they increased policy rates mainly. When did the inflation start to come down? Inflation peaked in September 2022. And since then, they didn't reduce the rates, they still kept the higher rate, right? Little by little, after that, inflation started to come down. So this is CCPI. Now, don't ask me what is CCPI. We learned. Same with NCPI. NCPI also peaked at 73% in September. And since then, both of this, CCPI and NCPI, two measures of inflation, both of it, little by little, started to come down. Is that clear? That's the story for now. Broader picture. We will go through this in detail. There are more policy instruments, Lamai. There is the SRR, there are open market operations, there are more things to do, but all of that today will be too much of into your head. Can you try to read and go through this part again? You all would have made some short notes also. Go through this part. It's not an easy part. You can't read the note and just understand. You need to have that in your head logically. This is what will happen. This is what will happen. You need to remember this like a story. Okay, so have that in mind. Done. Okay, shall we quickly do the quiz and then call it a day, or do you all want to do the quiz first thing in tomorrow? Now or first thing tomorrow? Tomorrow also we have class 8 to 10. First thing tomorrow? I guess going with the majority. Yeah, 17% short-term interest. Anyway, people will demand for loans, no? Anyway, it will go up. Okay, right. We'll do the first thing tomorrow. I guess tomorrow at 8, we'll do the quiz. And then tomorrow we'll go from around 8 to 10. Today is also around 2.5 hours only. The break and all. Tomorrow we'll do 8 to 10 and then we'll done. And most likely, again repeating, most likely next week, that quiz we will do it tomorrow morning, not tomorrow morning, first thing tomorrow. Most likely next week, I will take it all for theory. Instead of doing revision Monday, Tuesday, I'll take all 4 for theory in case we don't have the tut. That means the week after, now that means next week I will finish unit number 17. If I do 4 classes, I can finish 4 classes means around 8 hours. You can definitely finish unit number 7 next week. Then you have the week after we will only do revision. Then that means you can take a break to study unit number 7 and finish as well. Okay, right. So we'll call it a day. I'll see you all tomorrow at 8, where we do more in detail on monetary policy. So please go through and come, otherwise you all will be lost. See you and have a nice night. See you. Bye-bye.